There is a ghost in the machine of modern finance. It is a phantom that whispers in the ear of every investor, every CEO, every person saving for retirement. It is the voice of the economic forecast. It speaks in the language of interest rate projections, GDP growth targets, and inflation expectations. It is broadcast 24 hours a day on every financial news network, printed in the pages of every major newspaper, and debated endlessly by panels of experts whose resumes glitter with advanced degrees from the world's most prestigious universities. This voice promises a map of the future, a way to sidestep the coming recession or to ride the wave of the next boom. It offers the illusion of certainty in a world defined by chaos. And according to the single most successful investor in human history, listening to that voice is one of the fastest and most reliable ways to go broke. Warren Buffett, the man who built a personal fortune of over $100 billion and a corporate empire in Berkshire Hathaway worth nearly $1 trillion, has a simple and deeply unsettling message for anyone who consumes this daily diet of prediction. It is all noise. It is a siren song luring your portfolio onto the rocks of bad decisions. His entire philosophy, the bedrock of his unparalleled success, is built upon a radical act of intellectual defiance. He ignores, completely and utterly, all macroeconomic forecasts when making an investment decision. He does not care what the Federal Reserve will do next month. He does not have a view on whether GDP will grow by 2% or 3% next year. He doesn't know where the stock market is going, and more importantly, he knows that you don't know, and that the experts on television most certainly do not know. This isn't just a quirky habit of an eccentric billionaire. It is a powerful, calculated strategy that protects him from the single most costly mistake an investor can make: letting the grand, unknowable narrative of the economy distract from the small, knowable reality of a single business. While the rest of the world is paralyzed by fear during a downturn, waiting for an economist to give the all-clear signal, Buffett is buying. While the world is euphoric during a boom, convinced that the rosy forecasts will last forever, Buffett is often sitting on his hands, waiting for sanity to return. This is the great schism in the world of investing. On one side are the 99%, the market timers, the headline readers, the people who believe that successful investing is about correctly predicting the future. On the other side is Buffett, and a small cadre of value investors who believe that success comes from understanding the present value of a durable, money-making enterprise. This is not a debate about which investing strategy is better. The scoreboard speaks for itself. This is about a fundamental shift in mindset, a transformation that can free you from the anxiety of the daily news cycle and empower you to build lasting wealth, regardless of whether the economic winds are at your back or in your face. Today, we will deconstruct this philosophy. We are not just going to talk about it, we are going to install it as a new operating system for your financial mind. We will explore the 5 pillars that hold up this fortress of rational investing. We will begin by examining the primary defense mechanism Buffett uses to filter out the noise, his unwavering commitment to his circle of competence. We will then dissect the psychological traps and statistical fallacies that make economic forecasting so seductive and so dangerous. From there, we will build the positive case, detailing the specific business-focused analysis Buffett uses instead of a crystal ball. We will learn to harness the market's emotional insanity, driven by these forecasts, for our own profit, using the parable of Mr. Market. And finally, we will cement this long-term perspective with the ultimate commitment device, the 20-slot punch card. By the end of this journey, you will not just understand why your economist is broke, you will possess the mental tools to ensure you are not. You will have learned how to ignore the noise and focus on the one thing that creates real, enduring wealth: the simple, beautiful, and predictable power of a great business. The first line of defense, the great wall that protects the citadel of Berkshire Hathaway from the invading hordes of useless information, is a concept so simple it sounds almost trivial, yet it is the foundation of all intelligent decision-making. It is the circle of competence. For Warren Buffett, the world of knowledge is divided into 2 distinct domains: things he understands with absolute, granular clarity, and everything else. His genius is not in having a massive circle, It is in knowing with pinpoint accuracy where the perimeter lies and never ever stepping outside of it. Macroeconomic forecasting, with its infinite variables, feedback loops, and chaotic, unpredictable human element, lies so far outside his circle that it might as well be on another planet. He doesn't ignore economic forecasts because he thinks he's smarter than economists. He ignores them because he is smart enough to know that he is not a competent economist, and more profoundly, he believes that nobody is. To truly grasp how this principle works in practice, we must travel back to 1972. The American economy was a mess. The idyllic post-war boom was over, replaced by the anxieties of stagflation, a toxic cocktail of stagnant economic growth and high inflation. The Vietnam War was dragging on, the dollar had been decoupled from gold, and a sense of national malaise was setting in. The experts were grim. The consensus forecast was for more pain. Into this uncertain macroeconomic environment stepped Warren Buffett and his partner Charlie Munger, with an opportunity to buy a small, family-owned candy company based in California, See's Candies. The asking price was $30 million. The company was earning about $2 million after tax, meaning the sellers wanted a multiple of 15 times earnings. By the standards of the day, and by the standards of Buffett's own mentor Ben Graham, this was no statistical bargain. Graham taught him to buy companies for less than their liquidation value, to find cigar butts on the ground with one free puff left in them. See's Candies was not a cigar butt. It was a premium business at what seemed like a premium price. Buffett and Munger's initial offer was $25 million, and the See family, initially, was holding firm at $30. For a moment, it looked like the deal might fall apart over those $5 million. Now, consider what the typical investment committee, guided by economic forecasting, would have done in 1972. They would have looked at the rising inflation and concluded that consumers' discretionary income would be squeezed, hurting a luxury product like boxed chocolates. They would have looked at rising sugar prices, a key input cost, and projected shrinking margins. They would have seen the stagnant GDP growth and decided it was a terrible time to pay a premium for any business, let alone one selling a non-essential good. The macroeconomic narrative screamed, "Stay away." Every expert, every chart, every piece of stock market news would have advised caution. Portfolio paralysis would have been the rational response. Buffett didn't look at any of that. He didn't care about the GDP forecast for 1973. He cared about the experience of walking into a See's Candies store. He and Munger saw a business that commanded fanatical customer loyalty. They saw a brand that was synonymous with quality and nostalgia in its market. They saw that when a man had made a mistake with his wife or girlfriend, he didn't go to the generic drugstore to buy a cheap box of chocolates. He went to See's to fix the problem, and he didn't ask the price. This, Buffett realized, was a business with pricing power. It was a business that could raise its prices year after year to offset inflation, and its customers would happily pay because they weren't just buying chocolate, they were buying a feeling, a tradition, a solution. The circle of competence here was not about predicting the economy. It was about understanding the simple human dynamics of a consumer brand. Buffett understood loyalty. He understood habit. He understood the power of a brand that resides in the customer's mind. He understood that this little candy company had a deep and durable competitive moat. This was his turf. After some hesitation, he and Munger agreed to pay the $25 million they had offered, which the See family finally accepted. It was, at the time, the largest acquisition Berkshire Hathaway had ever made. The results were a revelation that would forever change Buffett's investing strategy, moving him from Graham's cigar butts to the philosophy of buying wonderful businesses at a fair price. Over the decades, See's Candies has generated more than $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It became the prototype for the kind of business Buffett would hunt for the rest of his career. The $25 million purchase price was returned to Berkshire in just a few years. The lesson was seismic. Understanding the microeconomics of a single superb business was infinitely more profitable than attempting to guess the macroeconomics of the entire world. The financial transformation came from realizing that a great business is a wealth creation machine that functions in both good and bad economies. The stock market news said the sky was falling, but inside the four walls of See's Candies, people were still happily buying chocolates. Buffett's focus was on the store, not the sky. The psychological principle underpinning this discipline is a powerful antidote to one of the most common cognitive poisons, the Dunning-Kruger effect. This is the well-documented bias where people with low ability at a task overestimate their ability. The beginner chess player who thinks he can challenge a grandmaster, the amateur investor who, after one successful stock pick in a bull market, believes he has a gift for beating the market. They don't know enough to know how much they don't know. This is the state in which most people operate when it comes to economic forecasting. They hear a cogent-sounding argument on television about interest rates, and because they understand the words, they believe they understand the staggeringly complex system behind them. They mistake familiarity for expertise. Warren Buffett operates from the opposite pole of intellectual humility. He exhibits the wisdom of a true expert, which is the profound recognition of the limits of one's own knowledge. He knows that business analysis is a game of knowable variables. You can read a balance sheet, you can assess a management team's track record, you can study a company's competitive position. It is difficult, but it is, at its core, a solvable problem. Macroeconomics, on the other hand, is what his partner Charlie Munger would call a lollapalooza of complex adaptive systems. It involves geopolitics, mass psychology, technological disruption, and the reflexive, often irrational, decisions of millions of independent actors. It is, for all intents and purposes, unknowable. Buffett's genius is not in being able to predict these things, but in recognizing that they are unpredictable and structuring his entire investing strategy around that fact. He avoids the Dunning-Kruger effect by refusing to play the game at all. This is a cornerstone of sound investment psychology. It's an admission that trying to be a master of everything makes you a master of nothing, and in the world of high-stakes portfolio management, that is a fatal flaw. So how can we as individual investors translate this powerful principle into a practical tool? We must build and maintain our own circle of competence. This isn't a passive exercise. It is an active, disciplined process of intellectual boundary setting. This is the blueprint. First, take out a piece of paper or open a new document. Title it, My Circle of Competence. Now, divide it into 3 columns. In the first column, list your professional expertise. Are you a software engineer? A doctor? A marketing manager? A plumber? Write down the industry you have worked in for years, the one where you understand the jargon, the competitive landscape, and the business models better than 99% of the population. In the second column, list your serious hobbies and passions. Are you a lifelong video gamer who understands the ecosystem of developers and publishers? Are you a car enthusiast who knows the supply chains and brand strengths of major automakers? Are you a home chef who intimately understands the grocery business and consumer packaged goods? List the areas where you have dedicated thousands of hours of your own time because of genuine interest. In the third column, list the products or services you use every single day and cannot live without. Your bank, your insurance provider, your cell phone company, the coffee shop on the corner. This is the raw material of your circle. The next step is to refine it. For each item on your list, you must be able to answer a simple question. What is the durable competitive advantage of the key players in this space? For the software company you work for, is it high switching costs? For the video game publisher, is it intellectual property? For your bank, is it a massive deposit base and regulatory hurdles? If you cannot articulate the moat in a single clear sentence, it's not in your circle. Be ruthless here. This is an exercise in intellectual honesty, not aspiration. The third and most crucial step is to create an anti-watch list, or, as Buffett and Munger call it, a too-hard pile. This is a list of industries you pledge to never invest in, simply because you do not understand them at a deep, fundamental level. For most people, this might include biotech, complex derivatives, or semiconductor manufacturing. Writing this list down is a powerful act of cognitive liberation. It frees you from feeling like you need to have an opinion on every hot stock or every economic trend. You are giving yourself permission to say, "I don't know and I don't care," which is one of the most powerful phrases in investing. Finally, every potential investment that enters your orbit must pass a simple one-paragraph test. You must be able to write, "I am considering investing in company X. I believe this is a good long-term investment because I understand how it makes money. Its primary business is Y, and its durable competitive advantage is Z. This advantage will likely protect it from competition for the next decade because of A, B, and C." If you cannot write this paragraph quickly and confidently, without referencing a talking head on TV or an analyst report, you are wandering outside your circle. You are gambling, not investing. This blueprint reorients your entire approach from "what will the economy do" to "do I understand this business?" It is the first and most important step toward financial independence. To fully appreciate the wisdom of this path, we must examine its opposite, the antithesis, the path of the 99%. This is the path of the expert chaser, the individual whose investment portfolio is a chaotic mess of reactions to the latest macro narrative. They suffer from a chronic case of intellectual FOMO, believing that riches lie just over the horizon in the industry they understand the least. The most catastrophic example of this in modern history was the dot-com bubble of the late 1990s. The macro narrative was intoxicating and, in a broad sense, correct. The internet was going to change the world. This prediction fueled a mania of epic proportions. People who had spent their careers as dentists, lawyers, and shop owners suddenly fancied themselves experts in telecommunications infrastructure, B2B e-commerce platforms, and online pet food delivery. They abandoned their own circles of competence because the story of the new economy was just too good to ignore. They poured their life savings into companies like Pets.com, Webvan, and GeoCities. What did these investors focus on? They focused on the macro prediction. They didn't ask, "Does this specific business have a moat?" They asked, "Is this an internet stock?" They didn't look at income statements. Most of these companies had no income. They didn't look at balance sheets. They were burning through cash at an astonishing rate. The business analysis was replaced entirely by the economic forecasting of a digital utopia. The stock market news was a daily drumbeat of dot-com IPOs, and everyone wanted a piece of the action. Meanwhile, where was Warren Buffett? He was on the sidelines, being openly mocked. A Barron's cover story in 1999 famously asked, "What's wrong, Warren?" His disciplined, value investing approach was seen as antiquated, a relic of a bygone era. He was a dinosaur who didn't get it. But Buffett wasn't ignoring the internet because he was old-fashioned. He was ignoring it because it was outside his circle of competence. He famously said he had no idea how to value these companies, no way of knowing which ones would be the winners and which would be the losers. So he did nothing. He stuck to businesses he understood, like Coca-Cola, Gillette, and American Express. When the bubble burst in 2000-2001, the expert chasers were wiped out. Trillions of dollars in paper wealth evaporated. People who had been millionaires one day were bankrupt the next. It was a brutal, devastating lesson in the danger of abandoning what you know in pursuit of a seductive story you don't. Buffett, on the other hand, saw his own portfolio, full of durable, old economy businesses, weather the storm and emerge stronger than ever. The path of the 99% is paved with the wreckage of those who chose to listen to the siren song of macro prediction over the quiet, boring wisdom of their own expertise. The financial connection here is direct, quantifiable, and profound. Operating within your circle of competence dramatically reduces the number of unforced errors in your portfolio. In investing, as in tennis, most points are not won, they are lost. The average investor loses not because they fail to pick the next Amazon, but because they make catastrophic mistakes, often by speculating in areas they don't understand. A single investment in a hyped-up speculative stock that goes to zero can wipe out the gains from a dozen solid, well-researched investments. Consider the financial impact on a balance sheet. A portfolio built inside a circle of competence will naturally have a lower turnover rate. When you buy a business you understand and intend to hold for the long term, you are not trading in and out based on quarterly earnings reports or Federal Reserve announcements. This lower turnover translates directly into lower transaction costs and, more importantly, deferred capital gains taxes. The ability to let your winners run, uninterrupted by the taxman, is one of the most powerful and underestimated forces in wealth creation. A hyperactive trader chasing macro trends might generate a 12% pre-tax return, but after fees and short-term capital gains taxes, their net return could be closer to 7%. A long-term investor with an 11% pre-tax return, held in a tax-deferred account, or simply held without selling, keeps nearly all of it working for them. Over a lifetime, this difference is not trivial. It is the difference between a comfortable retirement and true financial independence. Sticking to what you know isn't just a philosophical stance. It is a mathematical imperative for anyone serious about portfolio management. It is the first and most powerful reason Buffett ignores the noise. Even if we accept the wisdom of staying within our circle of competence, our brains remain vulnerable. We are wired to seek patterns, to crave certainty, and to listen to authority figures who promise to provide it. This leads us directly to the second pillar of Buffett's philosophy, a deep, abiding understanding of the fundamental fallacy of prediction and the dangerous illusion of control it provides. The entire multi-billion-dollar industry of economic forecasting is built not on a foundation of solid evidence, but on a quicksand of human psychology. Buffett doesn't just ignore the forecasts. He understands why they are structurally doomed to fail and why we are so desperate to believe them anyway. To see this principle in action under the most extreme pressure, we must rewind to October 19, 1987, a day forever seared into the annals of financial history as Black Monday. The Dow Jones Industrial Average plunged 508 points, a drop of 22.6%. It remains the largest one-day percentage loss in the market's history. The crash was swift, brutal, and seemingly out of nowhere. Panic gripped Wall Street. The technological systems that were supposed to make markets more efficient instead created a cascading waterfall of sell orders. Fortunes were vaporized in a matter of hours. In the aftermath, the economic forecasting industry went into overdrive. The predictions were apocalyptic. This was not just a correction. It was the beginning of a new Great Depression. Respected economists, Nobel laureates among them, appeared on television with grim faces, warning of imminent economic collapse, soaring unemployment, and corporate bankruptcies. The narrative was unified and terrifying. The party was over, and a long, dark winter was coming for the American economy. For any rational person watching the news, the only logical course of action was to sell everything that wasn't nailed down and retreat to the perceived safety of cash or gold. What was Warren Buffett doing? He was in Omaha, Nebraska, thousands of miles from the epicenter of the panic. He was not glued to his Quotron screen. He was not calling his broker with frantic sell orders. According to his biography, The Snowball, he was calmly reading his newspapers and annual reports, just like any other day. When asked about the crash, his response was simple. He didn't know what caused it, and he didn't know what the market would do tomorrow, next week, or next year. But he did know one thing. The businesses he owned through Berkshire Hathaway were just as good, just as profitable, and just as dominant in their industries on Tuesday, October 20th, as they had been on Friday, October 16th. The Washington Post was still the premier newspaper in the nation's capital. See's Candies was still selling delicious chocolates to loyal customers. The Buffalo News still had a stranglehold on its local advertising market. The market's price for these businesses had been cut by a quarter in a single day, but their underlying value had not changed one iota. The economic forecasting was focused on the collective madness of the crowd. Buffett's focus remained on the individual sanity of his businesses. He did not sell a single share. In fact, the crash and the subsequent pessimism created the very opportunities he craved. A year later, in 1988, with the memory of the crash still fresh and many investors still cowering on the sidelines, Buffett began to deploy Berkshire's capital aggressively. He famously invested over $1 billion to acquire 7% of the Coca-Cola Company. While others were paralyzed by the dire predictions of the macro profits, Buffett was busy buying one of the greatest businesses on earth at a reasonable price. The Black Monday crash for him was not a crisis. It was a fire sale. His refusal to listen to the forecasters allowed him to act rationally while the rest of the world was consumed by fear. This single decision to invest in Coca-Cola has since generated tens of billions of dollars in value for Berkshire shareholders, a direct result of choosing business analysis over market timing. The psychological drivers behind our obsession with forecasts are deeply ingrained in our evolutionary hardware. The first is the overconfidence bias. As humans, we have a tendency to overestimate our own knowledge and ability, especially when it comes to predicting the future. This is supercharged by the narrative fallacy, a term coined by Nassim Nicholas Taleb. Our brains are not built to process raw data and probabilities. They are built to process stories. We crave simple, linear narratives that explain cause and effect. An economist on TV provides exactly that. They don't say, "The market is a complex adaptive system with near-infinite variables, and its short-term movements are therefore inherently random." They say the Federal Reserve raised interest rates, which will slow down the housing market, which will cause a recession, so the market will go down. This is a clean, compelling story. It makes us feel like we understand what's happening. It gives us an illusion of control over a chaotic and frightening system. The problem is that these stories are almost always wrong. Extensive research, most notably by psychologist Philip Tetlock in his book Super Forecasting, has shown that the predictions of so-called experts are, on average, no more accurate than random chance. A chimpanzee throwing a dart at a board of possible outcomes would do just as well as the average geopolitical or economic pundit. The experts who are most confident in their predictions are often the most likely to be wrong. They are rewarded not for their accuracy but for the confidence and coherence of their storytelling. Financial television is not in the business of being right. It is in the business of selling certainty to an audience that is terrified of the unknown. Buffett understands this game. He knows that the product being sold is not accurate information, it is emotional comfort. And he knows that buying emotional comfort is a terrible investing strategy. This core tenet of investment psychology is what separates the professionals from the amateurs. The amateur seeks reassurance. The professional seeks value. To protect ourselves from this siren song, we must adopt a practical mental model for processing the endless stream of financial news and predictions. I call this the prediction inversion technique, combined with a strict news diet. It is a blueprint for reclaiming your mental bandwidth and making decisions based on signal, not noise. Step 1 is the news diet. You must radically curate your information intake. This means deleting the stock market app from your phone's home screen. It means canceling your subscription to the 24/7 financial news channel. It means unfollowing the market gurus on social media who make daily predictions. This is not about being uninformed. It is about being selectively informed. You can replace this fire hose of noise with a weekly or even monthly reading of high-quality, long-form business journalism and, most importantly, the annual reports of the companies you own or are interested in. Your goal is to shift your information consumption from 90% short-term noise and 10% long-term signal to the exact opposite. Step 2 is prediction inversion. When you inevitably encounter a prediction, perhaps a headline that screams "Top economist predicts 30% market crash," do not ask yourself, "Is this prediction true?" That is a fool's errand, as the future is unknowable. Instead, you must invert the question. Ask yourself 3 things. First, who is making this prediction, and what are they selling? Are they selling a newsletter? Are they trying to get clicks on a website? Are they a fund manager trying to attract assets by sounding smart? Understand their incentive. Second, ask, if I were to believe this prediction, what specific action would it cause me to take? Would it make me sell my stocks, go to cash, buy gold. Be very specific about the decision it is trying to provoke. Third, and most critically, ask, is that action consistent with my pre-established long-term investing strategy? If your strategy is to own a diversified portfolio of great businesses for the next 20 years, does a short-term market crash prediction change anything about the long-term value of those businesses? The answer, 99.9% of the time, will be a resounding no. This inversion process acts as a cognitive circuit breaker. It stops the emotional, fear-based part of your brain from taking over and forces the rational, strategic part to engage. As a final, powerful exercise, start a prediction journal. Every time you hear a major, confident prediction from a supposed expert, write it down with the date and the source. A year later, go back and review the journal. You will be astonished at how laughably wrong most of these confident pronouncements were. This is not to mock the predictors. It is to train your own brain to reflexively dismiss this category of information as entertainment, not actionable intelligence. This is how you move from being a consumer of stock market news to a practitioner of a disciplined investing strategy. The antithesis to this disciplined approach is the plight of the recession watcher. This is the investor who is perpetually terrified, constantly scanning the horizon for the next storm cloud. They are the market's ultimate victim of the narrative fallacy. They read an article in 2011 about the European debt crisis and decide to go to cash. They hear a forecast in 2014 about the taper tantrum and stay on the sidelines. They see predictions in 2016 about a global slowdown due to China and become convinced the market is about to roll over. They spend years, sometimes more than a decade, waiting for the perfect, risk-free moment to invest. A moment that the experts will surely announce for them. Of course, that moment never comes. While they are waiting, clutching their cash which is silently being eroded by inflation, the market embarks on one of the greatest bull runs in history. From 2010 to 2020, the S&P 500, including dividends, delivered an average annual return of over 13%. An investor who put $100,000 into a simple index fund in 2010 and simply ignored all the noise and predictions would have had over $350,000 by the end of the decade. The recession watcher who listened to the daily chorus of doom might have only $110,000 or $120,000, their capital having been eaten away by inflation and opportunity cost. They weren't stupid, they were simply misinformed. They were listening to the wrong people and asking the wrong questions. They were trying to time the market based on economic forecasting, a game that is rigged for failure. Their portfolio paralysis, born from a belief in prediction, cost them their shot at financial independence. The direct financial connection of ignoring forecasts is one of the most powerful mathematical realities in all of finance. It is the staggering cost of being out of the market. Research by firms like J.P. Morgan Asset Management has consistently shown that the vast majority of the stock market's long-term gains occur on just a handful of its best days. For example, in a 20-year period, if an investor missed just the 10 best days in the market, their total return would be cut in half. If they missed the 20 best days, their return would be almost completely wiped out. Now, when do these best days often occur? They frequently happen in the midst of turmoil and uncertainty, often immediately following the worst days. They are the snapback rallies that happen when pessimism is at its peak. The person who tries to time the market by selling after bad news and waiting for good news is almost guaranteed to miss these crucial days. The economic forecasters will never ring a bell at the bottom. By the time the economic data is positive and the experts declare the coast is clear, the market has already rallied 30 or 40% off its lows. Let's quantify this. Imagine two investors, each starting with $10,000 and adding $500 a month for 30 years. Investor A is a systematic investor. She invests her $500 on the first of every month, rain or shine, boom or bust. She ignores the stock market news entirely. Investor B is the prediction follower. She also saves $500 a month, but she only invests it when the headline economic news is positive. When she hears recession predictions, she stops investing and lets her cash pile up, waiting for the all clear. Over 30 years, it is almost a mathematical certainty that investor A will end up with a portfolio that is hundreds of thousands, if not millions of dollars larger than investor B's. The financial cost of listening to forecasters is not measured in basis points. It is measured in the forfeiture of entire life goals. It is the price of a secure retirement, the ability to pay for a child's education, the freedom that comes from true wealth creation. Ignoring the noise is not passive, it is an active and immensely profitable financial strategy. If we are to discard the faulty compass of economic forecasting, we must replace it with a true north. This brings us to the third and perhaps most crucial pillar of the Buffett philosophy: the active, relentless, and all-consuming focus on the individual business. This is the great business at a fair price doctrine. When you stop asking, what is the economy going to do, you free up an immense amount of mental energy to ask a much more important and answerable question: how good is this business? This is the offensive strategy that complements the defensive posture of ignoring macro noise. It is the engine of value creation. The quintessential story of this principle in action took place in 1963, a moment that would fundamentally alter Buffett's own understanding of investing. The protagonist was American Express, and the crisis was the salad oil scandal. A major client of American Express's warehousing division, a company called Allied Crude Vegetable Oil, had perpetrated a massive fraud. They had secured huge loans using barrels of salad oil as collateral. The twist was that the barrels were mostly filled with seawater, with just a thin layer of oil on top. When the fraud was discovered, Allied Crude went bankrupt, leaving its creditors, including American Express, on the hook for what was then an enormous sum, roughly $60 million. Wall Street panicked. The narrative, the macro story, was that American Express was ruined. Its name, built on trust, was now associated with a massive fraud. Analysts predicted that the losses could be existential, potentially wiping out the company's entire net worth. The stock price was cut in half, collapsing from over $60 to around $35 per share. The herd was selling, driven by a story of scandal and financial ruin. This was a classic case of market timing driven by fear. A young Warren Buffett, then running his small investment partnership in Omaha, saw the same headlines, but his reaction was entirely different. He did not ask, "What will this scandal do to the market's perception of financial companies?" He asked, quote, "Has this scandal impaired the fundamental, long-term earning power of American Express's core businesses?" To answer that question, he did not consult an economist or a market strategist. He became a detective. He started doing his own on-the-ground research, his own form of business analysis. He would go to restaurants and Omaha steakhouses, observing customers paying their bills. He would stand in line at banks, watching people buy travelers' checks. He talked to merchants, bankers, and travel agents. He was looking for the answer to one question: were people still using American Express cards and travelers' checks? Was the brand, in the mind of the end user, still powerful? The answer he found was an overwhelming yes. The traveling salesmen and diners he spoke to either hadn't heard of the salad oil scandal or didn't care. To them, the American Express brand still meant prestige, security, and convenience. The merchants still accepted the card because their best customers used it. The core franchise, the powerful moat around the payments and travel business, was completely intact. Convinced that the market was confusing a one-time, manageable loss in a peripheral division with a mortal wound to the company's heart, Buffett acted decisively. He invested 40% of his partnership's capital, a massive, concentrated bet, into American Express stock. It was the largest investment he had ever made. Over the next few years, as the company weathered the scandal and its core businesses continued to thrive, the stock price soared. Buffett's partnership made a fortune. This event was a crucible. It forged his understanding that the market, in its obsession with short-term narratives and macro fear, will periodically offer up wonderful businesses at ridiculously cheap prices. Your job is not to predict the storm, but to have the courage to buy the soundly built ship when it's being sold for the price of its wreckage. The psychological principle at work here is a counteragent to the focusing illusion. This is a cognitive bias, where we place too much importance on one aspect of an event, causing us to misjudge the bigger picture. The financial news is a machine designed to create focusing illusions. It screams about an earnings miss, a lawsuit, a bad economic report, or a political crisis, making that single data point seem like the only thing that matters. This triggers our emotional investing instincts and leads to rash decisions. Buffett's method is a conscious act of cognitive reframing. He deliberately ignores the object of the market's current obsession and shifts his focus to the timeless fundamental questions of business quality. What is the company's durable competitive advantage? How strong is its brand? Does it have pricing power? Is the management team honest and capable? Are the long-term economics of the industry favorable? By forcing his mind onto this checklist of business fundamentals, he starves the focusing illusion of the oxygen it needs to survive. He is replacing a short-term emotional question, "Should I be scared of this headline?" with a long-term rational question, "Is this a business I would want to own for a decade?" This mental discipline is not a small part of his success. It is the very essence of it. So how can we apply this? We need a practical blueprint, a checklist that forces us to think like a business owner, not a stock speculator. This is the business owner's litmus test, a 4-part filter for any potential investment. Part 1. The moat. Before you do anything else, you must be able to articulate the company's durable competitive advantage in a single, simple sentence. What protects it from competition? Examples include a powerful brand like Coca-Cola, a network effect like Facebook or Visa, high switching costs like Microsoft, or a low-cost advantage like Costco or Geico. If you have to write a long, convoluted paragraph full of jargon to explain the moat, it probably doesn't have one. Part 2. Management. Is the leadership team talented, honest, and shareholder-oriented? You are not just buying a stock, you are hiring a team of people to manage your capital. The best way to assess this is to read the CEO's annual letter to shareholders for the past 10 years. Is the language clear and candid, or is it full of corporate speak and excuses? Do they admit their mistakes? Do they talk about building long-term value, or are they obsessed with the quarterly stock price? You want to partner with managers who think and talk like owners. Part 3. Financials. You don't need a PhD in finance, but you must look at the numbers through a long-term lens. Pull up the company's financial statements for the past decade. Is revenue consistently growing? Are profit margins stable or increasing? How much debt does the company have? Most importantly, does it generate strong and consistent free cash flow, the actual cash left over after running the business that can be returned to shareholders or reinvested? You are looking for a track record of profitability and financial prudence, not a one-hit wonder. This is the heart of business analysis. Part 4. Price. This is the final and most difficult step. A wonderful business is not a wonderful investment if you pay too much for it. You must have a rough idea of what the business is worth and only buy when it is trading at a significant discount to that value. This doesn't mean finding the absolute cheapest stocks. It means paying a fair price for an excellent company. Buffett's mantra evolved from "buy a fair company at a wonderful price" to "buy a wonderful company at a fair price." The goal is not to time the market, but to wait patiently for the market to offer you a price that provides a margin of safety. This 4-part test shifts your entire frame of reference. It makes the daily chatter about economic forecasting completely irrelevant. If a company has a wide moat, great management, strong financials, and you've bought it at a reasonable price, do you really care if next quarter's GDP is 1.8% or 2.1%? The answer is no. You have engaged in a true long-term investing strategy. The antithesis of this disciplined approach is the story stock chaser. This investor is captivated by grand narratives about the future, often at the expense of present-day business realities. They buy companies that are not valued on their current earnings, but on the hope of enormous future earnings in a new and exciting industry. They are, in essence, making a macro prediction about a trend and then buying a lottery ticket on a company that might capitalize on it. Think of the cannabis stock boom a few years ago. The story was compelling, legalization is spreading, and a massive new market is opening up. Investors, ignoring the fundamentals, piled into any company with cannabis in its name. They didn't ask about moats. There were none, as it's a commodity product. They didn't scrutinize management. Many were unproven operators. They didn't look at financials. Virtually all were losing vast amounts of money. They bought the story, the macro forecast. The result was a bubble that predictably burst, wiping out billions in speculative capital. The story stock chaser confuses a great narrative with a great business. Buffett's approach is the exact opposite. He ignores the grand narrative and focuses exclusively on the boring, profitable reality of an individual enterprise. The direct financial connection of this approach is visible on the company's financial statements and, ultimately, in your portfolio's returns. A company with a wide moat has tangible, measurable characteristics. Look at the income statement of a company with immense pricing power, like See's Candies or Apple. You will see consistently high gross margins, because they don't have to compete on price. Look at their return on equity or return on invested capital. For great businesses, these numbers will be consistently high and stable, because they can reinvest their profits at very high rates of return. They don't need to take on a lot of debt to grow. They are self-funding cash machines. Compare this to a commodity business like an airline or a generic steel manufacturer. Their margins will be thin and volatile. Their returns on capital will be low. They are constantly at the mercy of economic cycles and price wars. One company is a fortress, capable of weathering any economic storm. The other is a rickety shack, liable to be blown over by the first ill wind. Over a 20 or 30-year period, the portfolio filled with fortresses will compound its way to a valuation that the portfolio of shacks cannot even dream of. This is the essence of beating the market. It is not about predicting the weather, it is about owning the unshakable buildings. This focus on business quality is the engine that drives true, sustainable wealth creation. Even with a commitment to our circle of competence and a focus on business fundamentals, we are still human. We are emotional creatures, susceptible to the madness of crowds. This brings us to the fourth pillar of Buffett's philosophy: mastering the psychology of the market by personifying it as a manic-depressive business partner named Mr. Market. Ignoring economic forecasts isn't just about filtering information. It's about building an emotional shield that allows you to profit from the fear and greed that those forecasts inevitably create in others. The perfect illustration of this principle is Buffett's investment in the Washington Post Company in 1973. The context was one of deep economic pessimism. The Nifty 50 growth stock bubble had just burst, wiping out a generation of investors who believed you could pay any price for a great company. The economy was mired in stagflation, and the Watergate scandal was beginning to cast a long shadow over the nation. The stock market was in a deep and prolonged bear market. The dominant macro forecast was for more gloom. It was a terrible time to be an investor, or so the experts said. Amidst this negativity, the Washington Post, a fantastic business, with a near monopoly on the print media market in the nation's capital, saw its stock get hammered along with everything else. The company had a dominant franchise, a powerful brand, and was trading at a valuation that was less than a fifth of what Buffett thought the entire business was worth. The market was valuing the entire company at about $80 million. Buffett knew that its individual television stations and real estate assets alone were likely worth more than that, meaning he was getting the world-famous newspaper for free. Why was such a jewel being offered at such a bargain price? Because of the macro environment. Investors were not looking at the specifics of the Washington Post. They were looking at the scary headlines about the economy and selling everything. They were gripped by fear, a classic case of emotional investing. This is where Buffett's concept of Mr. Market, an idea he learned from his mentor Ben Graham, became a powerful tool. He imagined the stock market not as an all-knowing judge of value, but as a bipolar business partner. Some days, Mr. Market would show up at his door euphoric, shouting about a glorious future and offering to buy Buffett's shares at ridiculously high prices. On those days, Buffett might be tempted to sell. Other days, like in 1973, Mr. Market would show up despondent and terrified, convinced the world was ending, and offer to sell his own shares in great businesses for pennies on the dollar. On those days, Buffett would happily buy. The key is that Mr. Market is there to serve you, not to guide you. You are free to ignore him or to take advantage of his irrational moods. You must not, under any circumstances, allow his emotional state to influence your own. In 1973, Mr. Market was in a deep depression regarding the Washington Post. The economic forecasts were feeding his despair. Buffett, emotionally detached and focused solely on the underlying value of the business, saw not a crisis, but a once-in-a-lifetime opportunity. He began buying shares aggressively, investing about $11 million to acquire a large stake in the company. That investment would go on to become one of the cornerstones of Berkshire Hathaway's success, eventually becoming worth over $1 billion. He used the market's macro-induced panic as his entry point. He didn't have to predict the economy would get better, he just had to know that the Washington Post was a great business and that the price being offered was absurdly low. The psychological principles that Mr. Market helps us overcome are two of the most powerful and destructive forces in human nature: loss aversion and herd behavior. Loss aversion is the well-documented phenomenon that the pain of losing is psychologically about twice as powerful as the pleasure of gaining. A $1,000 loss feels much worse than a $1,000 gain feels good. This makes us instinctively risk-averse when it comes to our finances. When macro news turns sour and our portfolio starts to decline, loss aversion kicks in with brutal force, creating a powerful urge to sell and make the pain stop, even if it's precisely the wrong financial decision. Herd behavior is our deep-seated instinct to follow the crowd. For most of human history, straying from the tribe was a death sentence. This instinct is still with us. When everyone around us is panicking and selling, it feels physically and emotionally unsafe to stand apart and buy. The news amplifies this, showing images of frantic traders and flashing red arrows, creating a sense of universal consensus that the ship is sinking. Personifying these forces as the single, flawed character of Mr. Market is a brilliant psychological hack. It depersonalizes the pressure. You're not fighting the whole world. You're just dealing with your crazy but ultimately harmless business partner. It allows you to step back, observe the madness from a distance, and act rationally. This is the essence of advanced investment psychology. To operationalize this, we can use a practical blueprint called the Mr. Market Visualization Exercise. It's a mental model to be deployed whenever you feel the urge to act based on market volatility or scary news. First, before you look at your portfolio or check the market, stop. Close your eyes for a moment and consciously create the character of Mr. Market in your mind. Is he showing up at your door today? What is his mood? Is he wearing a party hat, shouting about new all-time highs, and offering you absurd prices for your shares? A moment of greed. Or is he dressed in rags, weeping about an impending recession, and begging you to take his valuable assets off his hands for a pittance? A moment of fear. Give him a face, a voice, make him real. Second, understand your role. Your job is not to argue with him, comfort him, or get caught up in his drama. Your job is to transact with him only when it is to your clear advantage. This requires having a pre-prepared plan. You must create a shopping list of 5 to 10 wonderful companies that you have already researched using the business owner's litmus test. Next to each company name, write down a panic price, a price at which you would be thrilled to become an owner, a price you believe offers a significant margin of safety. Third, the rule of engagement is simple. You only answer the door when Mr. Market is in a state of utter despair. You look at your shopping list. Is he offering you one of your target companies at or below your predetermined panic price? If yes, you transact. You calmly and gratefully take the shares off his hands. If no, you politely say, "Not today, thank you," and you close the door. You do not let his euphoria tempt you into buying at the top, and you do not let his despair scare you into selling at the bottom. This framework turns you from a passive victim of market emotion into an active exploiter of it, a crucial step in any successful long-term investing strategy. The antithesis of this rational approach is the all-too-common buy high, sell low cycle, the tragic path walked by the majority of emotional investors. Their journey is a perfect reflection of Mr. Market's moods. The cycle begins with optimism. The market is rising, the economic news is good, and stories of overnight millionaires are everywhere. They feel a powerful sense of FOMO, fear of missing out. They can't stand to be on the sidelines any longer, so they buy, often near the peak of the market's euphoria. For a while, things go well, reinforcing their decision. But then, the mood shifts. The economy slows, a crisis hits, and the forecasts turn negative. The market begins to fall. At first, they hold on, hoping it's a temporary blip, but the decline continues. Their portfolio, once a source of pride, is now a source of constant anxiety. The pain of their losses, amplified by loss aversion, becomes unbearable. The news is a constant drumbeat of doom. The herd is stampeding for the exits. Finally, they can't take it anymore. They sell, often near the point of maximum pessimism, just to stop the bleeding. They lock in their losses and retreat to the safety of cash, vowing never to invest again. Of course, the market eventually bottoms and begins a new ascent, leaving them behind. They bought at the point of maximum greed and sold at the point of maximum fear, the exact opposite of the Buffett doctrine. The direct financial connection of mastering Mr. Market's moods is the mathematical magic of asymmetrical returns. Imagine a stock is trading at $100. The market panics over some economic forecast, and the stock drops 50% to $50. The emotional investor who owned it at $100 and sold at $50 has suffered a catastrophic 50% loss. To get back to even, they would need to find a new investment that generates a 100% return, a very tall order. Now consider the rational investor, using the Mr. Market blueprint. She has the Washington Post on her shopping list with a panic price of $55. When the stock hits $50, she sees her opportunity and buys. For her, the subsequent journey from $50 back to $100 is not a break-even recovery. It is a 100% gain on her investment. The exact same price movement, from $100 down to $50 and back up to $100, creates a devastating loss for the emotional investor and a spectacular gain for the rational one. The difference is not intelligence or information, it is temperament. It is the ability to be greedy when others are fearful, and fearful when others are greedy. This emotional discipline, more than any stock-picking skill, is the true engine of wealth creation and the ultimate key to beating the market. We have built a strong defense and a powerful offense. We know to stay in our circle of competence, to ignore forecasts, to focus on business quality, and to exploit the market's emotional swings. But all of this can be undone by a single, pervasive flaw in modern financial culture: short-termism. The final pillar of Buffett's philosophy is a mental framework designed to eradicate this flaw, to force a long-term perspective so powerful that it makes quarterly economic data and daily market wiggles seem completely absurd. This is the 20-slot punch card mentality. Buffett first articulated this powerful analogy early in his career, and it remains one of his most profound mental models. He told his students to imagine that when they graduate, they will be given a punch card with only 20 slots on it. Each time they make an investment, they have to punch one of the slots. That's it. They get only 20 investment decisions for their entire life. Under those conditions, he argued, you would think very, very carefully about each decision. You would do exhaustive research. You would wait for the absolute perfect pitch, and once you made a decision, you would stick with it for a very long time. You would, in short, be forced to adopt a truly long-term investing strategy. This is not just a clever thought experiment. It is the philosophical underpinning of Berkshire Hathaway's biggest and boldest moves. Consider the acquisition of the Burlington Northern Santa Fe (BNSF) Railroad in 2009. The deal, valued at $44 billion, was the largest in Berkshire's history, And the timing was extraordinary. It was late 2009. The world was just beginning to climb out of the wreckage of the greatest financial crisis since the Great Depression. The economic forecasts were still tentative and fearful. Many experts were predicting a double-dip recession or a decade of stagnant growth. The macro outlook was, to put it mildly, uncertain. Buffett's purchase of BNSF was not a trade based on the next year's GDP figures. It was, as he called it, an all-in wager on the economic future of the United States. A railroad is a bet on the fundamental long-term productive capacity of a country. It moves the grain, the coal, the cars, the consumer goods, the very lifeblood of the economy. This was not a decision you make if you are worried about the next inflation report from the Federal Reserve. This was a decision you make when your time horizon is not measured in quarters but in decades. It was a 20-slot punch card decision. He was effectively punching a hole and saying, "This is one of the 20 businesses I want to own for the rest of my life." This mentality renders short-term economic forecasting completely and utterly irrelevant. If you are buying a business with the intention of holding it for 20 or 30 years, what possible difference does it make if there's a recession next year? A great business will not only survive a recession, it will likely emerge stronger as weaker competitors fall by the wayside. The punch card forces you to lift your gaze from the pavement just in front of you and look to the distant horizon. It is the ultimate antidote to the market timing impulse that plagues so many investors. The psychological principle that the punch card mentality harnesses is the endowment effect, amplified by commitment bias. The endowment effect is our tendency to value something more highly simply because we own it. If you are given a coffee mug, you will demand a higher price to sell it than you would have been willing to pay to buy it a moment before. Ownership creates an emotional attachment. The punch card ingeniously creates this sense of endowment before you even make the purchase. By framing the decision as one of only 20 you will ever get, it makes each potential choice feel incredibly precious. You start to think like an owner before you've even spent a dime. This pre-commitment counteracts the modern financial world's bias for action. The constant stream of stock market news, the flashing prices, the low-cost trading apps, they all encourage a "what's next" mentality. We are conditioned to be constantly tinkering, trading, and adjusting. The punch card is a powerful brake on this impulse. It forces patience and selectivity. It shifts the default from action to inaction, which is often the wisest course. This is a profound shift in investment psychology, moving from the mindset of a trader to the mindset of a capital allocator. To put this into practice, we can create our own digital punch card system. It is a simple but powerful blueprint for enforcing long-term thinking and improving executive decision-making in your own portfolio. Step 1. Create a document. It can be a simple text file, a spreadsheet, or even a physical notebook. At the top, write "My 20-slot punch card." Below, list the numbers 1 through 20, leaving a large space next to each one. This is your career-long investment ledger. Step 2. Establish the rule. From this day forward, any new, significant capital allocation into a single stock must earn one of these slots. This does not apply to index funds or diversification tools, but to the concentrated, high-conviction bets that you believe will truly drive your wealth creation. Before you can punch a slot, you must write a one-page investment thesis memo. Step 3. The memo. This memo is non-negotiable. It must clearly state the company's moat, the quality of its management, the strength of its financials, and the reasons you believe the current price offers a margin of safety. Most importantly, the memo must contain a, quote, lockup clause. You must write a paragraph that begins, "I would be happy to own this business even if the stock market were to close for the next 5 years and I could not sell my shares, because..." This forces you to divorce the investment decision from the short-term stock price and focus solely on the long-term prospects of the underlying business. This simple system changes everything. It elevates the gravity of each decision. It filters out the noise of market timing and hot tips. It forces you to only swing at the fat pitches, the rare, obvious opportunities. It is the ultimate practical exercise in developing the temperament required for long-term investing and achieving financial independence. The antithesis to the punch card mentality is the day trader or gambler's mindset. This is the individual who sees the stock market as a casino. Their screen is a dizzying array of charts, indicators, and real-time news feeds. They are not investing in businesses. They are betting on the direction of squiggly lines. Their decisions are not based on 10 years of financial data, but on 10 seconds of price momentum. They are constantly reacting to whispers about Fed announcements, CPI data, and geopolitical tensions. Their portfolio is not a curated collection of quality assets. It is a chaotic churn of tickers, held for hours or days at a time. This approach is the embodiment of short-termism. It is a world where macroeconomic forecasting is not just relevant, but the only thing that matters. But it is a deeply flawed and, for most, a financially ruinous path. The day trader is engaged in a zero-sum game against high-frequency trading algorithms and massive institutional players. They are a guppy swimming in a shark tank. The stress is immense, the odds are long, and the path is littered with blown-up accounts and shattered dreams. The direct financial connection of adopting a punch card mentality is the dramatic reduction of what we can call the cost of friction. Investing is one of the few endeavors where frenetic activity is punished and disciplined inactivity is rewarded. Every time the day trader makes a transaction, they are losing money in 3 ways. First, there are commissions and fees, which, though small on a per-trade basis, add up to a significant drag on performance over thousands of trades. Second, and more insidiously, is the bid-ask spread, the small difference between the price you can buy a stock for and the price you can sell it for at any given moment. For an active trader, this spread is a constant tax on their activity. Third, and most punishingly, are the taxes. In the United States, gains on investments held for less than a year are taxed as short-term capital gains, which are taxed at the same high rates as ordinary income. Gains on investments held for more than a year are taxed at much lower long-term capital gains rates. A long-term punch card investor who generates a 10% return might keep 8.5% of it after taxes. A hyperactive day trader who also generates a 10% gross return could easily see their net after-tax return fall to 6% or less after accounting for higher tax rates and frictional costs. Over an investing lifetime, this friction gap creates a chasm of wealth. It is the silent, mathematical destroyer of the active trader's portfolio and the silent, powerful tailwind for the long-term owner. The 20-slot punch card is not just a quaint analogy. It is a financially optimized strategy for minimizing friction and maximizing the long-term compounding of capital. It is the final, essential pillar that allows you to build a weatherproof portfolio, one that can stand for decades, impervious to the howling winds of economic forecasting. You have made a significant investment of your most valuable asset, your time. And in return, you have acquired a powerful mental arsenal, a complete framework for seeing the world of money and investing not through the foggy, distorted lens of economic prediction, but with the clarity of a business owner. You've learned to build a fortress around your mind with the circle of competence. You've been armed with the intellectual shields to deflect the fallacies and psychological traps of the forecasting industry. You now possess the blueprint for analyzing businesses like a pro and the emotional discipline to use Mr. Market's madness to your advantage, not your detriment. And finally, you have the ultimate long-term commitment device in the 20-slot punch card. This is more than just a collection of tips. It is a fundamental shift in your financial identity. But it is crucial to understand that this is not the end of the journey. What you have just mastered is one powerful foundational network of ideas within the much larger, interconnected system of thought that constitutes a truly wealthy mind. The principles of ignoring macro noise are deeply linked to other, equally powerful mental models for understanding risk, allocating capital, and negotiating business. It's like learning the rules for how the bishop moves in chess. It's a vital piece of the game, but it is not the whole game. To truly dominate the board, you need to understand how all the pieces work together in harmony. The next piece of this map, the next link in this chain of mental models, is waiting for you. The video that is about to appear on your screen is not an accident. It has been selected because it contains the knowledge that connects directly to what you have just learned. It might be the model for assessing management, or the framework for understanding debt, or the psychological trick for thinking in decades, not days. It is the missing link, the piece that will take the foundation you've built today and add the next level to the skyscraper of your financial acumen. The choice to click is not just about watching another video, it is a decision about who you want to become. Are you a passive consumer of financial entertainment, or are you an active builder of your own mental arsenal? The dabblers will stop here, satisfied with what they've learned. The true architects of their own success, the people who are serious about achieving financial freedom, will see this as a challenge. They will recognize the opportunity to continue their ascent, to add the next weapon to their collection, to complete the map. The choice is yours. Complete the set. Continue your journey. Click and master the next piece.